First of all, thanks for the organizer to put such a nice program together. It's really a pleasure to be here. So this is going to be a paper that's going to look at financing investment. And we're going to have two technical innovations: is put long-term debt and add uncertainty shocks. This paper is co-authored with Francois Gourio, who's currently at the Fed Chicago. So why do we need long-term debt? The recent literature on quantitative corporate finance, exemplified by Hennessy and Whitehead or Gomez, consider only short-term debt. So you write a model of financing and investment, but you only want contract for debt that have to be rebalanced every period. The reason for that is largely computational. Right? It's just a lot more difficult to compute long-term debt. I motivate this with corporate finance, but you can also think of this in the context of sovereign debt, which has been also studied. But for now, they have abstracted from investment. So I'll look at this in the context of a firm. So we're going to argue that that's not a costless simplification because if you borrow $1 that you promise to repay tomorrow and you invest this into capital, this capital is going to be productive for a lifetime. So there's an inherent maturity mismatch built in between the financing and the investment. And this is going to essentially create agency cost, right? If you're a bondholder, and you can imagine competitive lenders, and you're willing to propose a schedule of one-period debt loans with default costs, with credit risk, you're only going to know investment and debt for the next period. However, period 12, period 15, you cannot really enforce an investment policy, a debt policy, or even an equity issuance policy. So you can get diluted. Bad things can happen to you as a bondholder. So if I issue a one-period bond, I can guarantee that if I issue a long horizon debt, I don't control that, and those agency costs are going to come out of that. Also, I already mentioned it, but there's going to be a maturity mismatch and a rollover risk that's going to be built in when you do a one-period debt, right? Because to finance a $1 is going to produce for a long time, you're going to have to roll over each period this financing. So that creates a rollover risk. And moreover, when people considered those short-term debt, it was very difficult to create credit spread that were consistent with the data. Okay? So what we're going to a credit spread is going to be the cost of debt beyond the risk-free rate. So it's going to price in the credit risk involved with that contract. Okay? We're going to have default, yes. That's what makes the problem very difficult. So what we're going to find, if I don't get to the end of the talk, mostly is going to reduce leverage. So borrowers will be reducing how much they issue debt quite a bit. It's going to generate a lot more default. We'll see that when you have a one-period debt economy, it's very hard to generate default. You have to do crazy things. When you have long-term debt, not so much. And we're going to generate more credit spread. So the cost of that is going to be more in line with the data. Okay? Also, it's going to amplify the response to investment to the change of credit spread. So those things are going to tie up together a bit stronger. The second innovation is we had uncertainty shock. So we're going to have cash flows are going to be have a volatility, and this is going to follow a Markov chain with two states. So why do we need to introduce that? Well, we're going to argue that this is going to also improve the fit as far as the Q theory. So we know from the fundamental work of Hayashi and Abel that Tobin's Q should be a sufficient statistic for investment. So in those very simplified model, the model prediction is that Tobin's Q should tell you exactly how much a firm should invest. Okay?
Well, we know under very extreme assumption.
Under very extreme assumption. It's from the 70s.
Yeah.
But we know it doesn't work well empirically. So people have tried to patch this theory up. Some people have argued measurement error. Have been quite successful. And more recently, there's been a strain of literature that has argued that actually it works better with bond prices or credit spread. So we are able to predict investment a lot better when we use measures of the cost of debt for firms. Gilchrist and Krychek, Philippon has a fairly recent paper that have explored that channel. Okay? So we think that adding uncertainty shocks will actually help the fit of the data. Why? Why would you say? So consider a world. I'm going to just argue loosely here, and I'll show the model right after. Imagine a positive shock to productivity. What does it do? So Z goes up. It decreases the probability of default. So the cost of debt, your credit spread, goes down. As your productivity goes up, your MPK goes up. So you're going to increase your investment, and that's going to increase your Q. So Tobin's Q, as a reminder, is market value of the firm over the book value of assets. So it's a sense of equity value of the firm. So as you can see, correlation between investment rate and Q is positive. Correlation between investment rate and spread is negative. So that's our standard Hayashi model in a way. That's our standard intuition about productivity shock. Think about a shock to volatility now. My cash flow have a low volatility, and today I enter a world with more volatility. What happens? The probability of default goes up, of course, because my cash flows are a lot more volatile. That's going to increase my credit spread, right? Lenders will require a higher return on their debt. We know that when volatility increases in the presence of adjustment costs, especially partially reversible investment, it's going to decrease investment. That's those real option type intuition from Pindyck, goes way back. So investment is going to tend to go down. It's the wait and see effect. At the same time, if the firm is fairly close to default and have this limited liability option, Tobin's Q will go up because the growth option value now has gone up tremendously because I like to take a gamble when I'm very close to defaulting, essentially. Right? So what does it generate? The correlation between Tobin's Q and investment rate is now negative, while the correlation between Tobin's Q and the credit spread is also negative. So you can see correlation with investment Q and spread goes the same direction here, goes upward direction here. So we're going to see that a world that has those two shocks in it will tend to, those two effects will go against each other, while those two effects will reinforce each other. So we think that's a world that's going to help us tighten the connection between investment rates and credit spreads and lower the connection between Q and investment. And this gets us closer to data. So that's the broad motivation. So what are we going to do? We're going to extend those neoclassical model of financing and investment to incorporate long-term and stochastic volatility, and we're going to explore the quantitative impact. We started that 3 years ago. That's why I'm in this workshop today. We're going to find that it's very difficult to compute, and I'll try to emphasize the algorithm as well as the solution method. Okay. So let me just show you the model, so we all know exactly what we do, and then I'll show you the solution method and the results. So the model built on Gomez-Schmidt, for those who are familiar. So it's going to be a fully dynamic, partial equilibrium model with an exogenous pricing kernel. So right off the bat, this is corporate finance. We look at portfolio problems. Okay, so there's not going to be any equilibrium effects here.
So it's actually an individual decision.
Correct. It's a decision.
There's no market price that we can do.
Correct. There's going to be bond price and assessment in order equation.
Yeah. So this is just an optimal decision.
Correct.
So partial equilibrium makes you think that there's some market that has a exogenous price in
the firm value is going to be priced on decision, but
yeah, that's just a reaction to whatever the firm does.
Yes.
So there's no equilibrium computation at all.
No, that's right. That's exactly right.
Is that what macroeconomics do by partial equilibrium?
I guess we're arguing semantics, but yeah, you're correct. You're right. That's what I do. That's right. So the financial decisions are going to have debt, equity issuance, and default, and the real decisions are going to be investment, right? So if you want to think of this work in terms of sovereign debt, people have looked at this shutting down investment, just looking at the issuance of a sovereign. So the departure from literature, as I said already, is going to be shock to volatility, productivity, and long-term debt. So time is discrete, problem is infinite horizon. The uncertainty is going to come from three pieces. There's going to be an aggregate productivity shock, ZA. There's going to be an idiosyncratic productivity shock, ZI. So that's going to be firm-specific. Every firm will be hit with the same shock. And the idiosyncratic volatility, sigma, is going to denote tomorrow's shock's volatility. So if I get hit with a sigma high today, it means that the dispersion of my cash flows tomorrow is going to be high. Okay? So sigma is the volatility of Z prime I. Okay? So I'm going to denote all of those states, and I collect them and stack them into this vector, ZA, ZI, and sigma. Okay? So the firm is going to produce profit using physical capital, and of course the productivity shocks. The firm is going to invest in capital. Capital will depreciate at rate delta. And there's going to be, for this presentation, it's relaxed in the paper. For simplicity, it's going to be irreversible investment. And we're going to have linear costs of adjusting capital. Again, not a big deal, but for exposition, it's simpler for you to see. And then we're going to have, now we're going to have to put debt. So if you want to put long-term debt, how do you do it? You can have finite horizon debt. You can have 1-period debt, 2-period debt, 3-period debt. The problem is if you have a 15-period debt, it matures to 14. So if you have end period debt, you're going to have end states. So one parsimonious way to have this risk is to introduce a debt that's decaying over time, that's mimicking investment in some ways. So what we're going to have is we're going to have long-term exponentially decaying debt, and the stock is going to be denoted by B. And every period you come up with a stock B, every period you're going to pay delta B. Next period you're going to have 1 minus delta B times B left. Then the following period you're going to pay delta B again. But this we're going to allow to rebalance every period. Okay? So it's a nice way to have a long-term debt, but keep one state variable. Okay? So the firm is going to be able to issue equity. Yep.
Funny question, the linear adjustment cost, I'm a little confused with that. Usually we tend to if we want to introduce one adjustment cost, we want to say that it's harder to sell. You know, there's some reasons why it's harder to sell an asset after you bought it. But here you're seeming to say that the adjustment cost only applies if you're increasing.
That's right. So if you want to put $1, it's going to cost you $1.10, but you can't disinvest.
It's infinitely costly to disinvest.
Oh.
So it is
Oh,
more
totally
costly.
irreversible. Okay.
That's right. So for here, if you plot investment rate,
I'm sorry, I was thinking,
capital,
I was thinking irreversible investment just meant you could pay.
irreversible and costly upward. So you could put a convex with a different slope upward and downward. I think that's funny too. That's what we do in the paper with estimate. So here, irreversible investment.
What's the, how much of a tricky of this?
I'm going to show you calibrate examples with a 1-period debt, a 5-period debt, and a 10-period debt. So I can vary that, but that's a fixed parameter. The firm does not choose the maturity of the debt.
What do you mean by maturity?
So maturity is not defined, but it's going to be the concept of duration.
Okay, so it's like you got an exponential thing, it's
Correct.
like a mean or something.
Exactly. So if delta is 0.2, you can think of it as a 5-period debt. It's a 5-period duration, so it's roughly a 5-period debt. In terms of interest rate risk, it would be 5 period. So dividend is going to be denoted by D, and if it's negative, we're going to interpret this as being equity issuance. And then the firm
What is equity insurance?
equity issuance.
Issue.
So the firm issues equity. So when dividend is negative, you get more money from your shareholders.
Oh. So issuing equity is the same as a negative dividend.
Correct. It's like you give me money.
Okay.
It's an economical way to think about it. So you don't have to.
There's big transaction costs to issuing
Yes.
equity.
Oh, I'll get to that.
And you're ignoring that.
No, I'll get to that. I have friction in that. But this is the interpretation. Then the firm value is going to be denoted by D. It's going to be equity value, and if it's negative, I'm going to give the firm the option to default. So if it's negative, you can basically walk away. We're going to have taxes in this model. Profits are taxed at a rate tau, and it's net of interest expense. So whatever interest expense I issue in my debt, I can shield that off. Okay.
So that's the motivating thing about why you have.
That's going to be one of the drivers to issue debt, as well as funding investment. That's right. So it's going to be the standard distress tax benefit of issuing debt versus distress costs is going to give us an interior solution for that, yes. So if you formalize the problem, firms will maximize the expected discounted stream of dividends. So we can denote this as D plus the expectation of that. This is going to be your pricing kernel. And this is going to be V prime, but max of 0 and V prime. So that's our default option here. Okay. So let me show you the budget constraint. This is our dividend. So we're going to produce pi. We're going to pay a tax tau. This is our after-tax profit. We're going to issue new loans. The new loans are going to be called L, and Q is going to be the price of a $1 of new bond issuance. And I'm going to show you that in the slide. Then you repay your delta B times B debt repayment, right? This is what you have to rebalance every period. So if it was a 1-period debt, this delta would be 1, and then you'd repay your full debt every period as is standard in the literature. Then you invest I, and you pay your cost of investment. So if that D tilde is negative, it's an equity issuance. You're going to be penalized by a proportional cost lambda. You could make that a quadratic cost. It's a quantitative question. So when D is negative, if it's minus $1, it's actually going to cost you $1.10 in terms of the stream to
More like a fixed cost plus maybe a marginal cost?
You could parameterize this in various ways, depending on which moments you want to target later on. This is a simplified way, but you could imagine something a bit more fancy, correct? So if you have new loan, they'll sell at price Q, that I'll show you later, and that starts looking like this investment, right? So it's going to be B prime minus 1 minus delta B times B, and if this is different than 0, then it means you're issuing new loans today. So you're increasing your stock beyond natural repayment, okay? So what is this Q price of a $1 loan, which has been featured in many of my dreams and nightmares? So you're gonna issue $1 today. You're gonna repay this $1, but you're gonna repay delta B. That's if you continue operation. Then you're gonna repay in 2 periods delta B times 1 minus delta B. Right? The stock is depleted, and so on and so forth. So you're gonna have this telescopic sum of repayment of that $1 over time. That's if you never default. Right? Now, if you default, that goes away, and what you do is you recover the physical capital stock over the debt outstanding. Right? There's $10 left in the firm. There's $5 outstanding. You recover $2 per dollar that's been invested. And then because you can't recover all of it, there's going to be a psi percentage of that's recovered by the bondholder. So that's, you can think of this as the discount, the haircut on that bond when it's being repurchased, or the legal cost, the physical cost of repossessing the capital and selling it back. And that typically is somewhere around 80–90%. That could be estimated, that could be calibrated. Okay. If you don't default, if you default in period 2, it's that indicator is going to pop, and you're going to recover this. Okay. So you can also write this in the telescopic sum as well. You can already see the nice feature of that expression is that it's recursive. Okay. So given the firm's policies, capital and debt, the loan price is going to satisfy this equation. So the price of a bond today is going to be the discounted sum of its payment delta, or its default value. And if it does not default, then you get 1 minus delta share of the bond price tomorrow. Right? So now you can solve this recursively.
Now, the price I pay depends on my state's A prime and B prime, right?
Correct.
So what I, yeah, so then now,
Here, the default.
okay, so then the marginal cost of financing is the partial of Q with respect to B prime.
Correct.
Okay,
That's right.
so it's not taking exogenously, that's right.
So this is going to be a schedule.
Yeah, yeah.
So the firm will take that schedule as given. Let me show you. Let me finish with this, and I'll show you the full program that I'm solving. So this is what the bond price is to satisfy for the lenders to break even on average when lending to a firm. Okay. I told you that the interest payments are subsidized. So if you wrote the bond price Q in terms of the yield, you'd have to look at the after-tax yield, right? C of Q being the yield that this bond. And so what you can do is you can rewrite that Q tilde as a function of Q, and it has the tax shield embedded into it. So it's a little bit cheaper for the firm to borrow because of that, okay? So once I compute the fair bond price, I can include the tax benefit embedded into it, okay? So that's gonna give us, so this is what the firm is solving. Given this bond price schedule, which depends on, obviously, what I can contract on, my capital, my debt tomorrow, and the state today, the productivity states, and that's it. Right? After that, this is solved using the policy functions, right? And that's where the agency costs come in. Right? But given that, I can contract on that. So the firm takes that schedule, that cost of new debt as given, and solve this optimization program that I showed you already. Okay? So this Q here is a schedule. Okay? So the equilibrium, or maybe I shouldn't call it that way, but this recursive equilibrium here is going to be this bond schedule by the lenders and this value function by the firm, and the firm policy function, capital and financing. And the value function is going to solve this Bellman equation given this bond pricing, and the loan schedule is going to satisfy the Euler equation given the firm policy function. And you can already see that it's going to be some iteration going.
There's a game between the two.
It's not a game per se, because this Q satisfies the average firm.
Yeah, but at time zero, when, actually the lender at time zero says, here's my schedule. And then at time zero, the firm makes a bunch of decisions. And then, the schedule has to be compatible with the firm's strategy. And so it's like,
Because the firm doesn't have the ability to commit in the future, can only commit for one period,
yeah, it's still
the bond price is gonna be pricing that in. Yeah, you're right. Yeah, that's right.
perfect.
Yeah, you can think. Yeah, that's right. You can think of it this way. They can only commit for one period, because the bond schedule is only on K prime and B prime.
Both commit.
Because otherwise they would renegotiate when the debt, when there is a time of default, they would like both to renegotiate.
What? So the bondholders know the firm cannot commit, so they're gonna price in their optimal response. They can only commit on Q prime and B prime.
I think the lenders commit,
The lenders commit, yeah. But the firm cannot commit.
but renegotiation does happen in the real world.
Yes. So we abstract from that in a way, yeah. Okay. So let me get to the juice now, the interesting stuff. So how do we solve this model? You can see you have to satisfy those two guys, optimal response. You're gonna have an inner loop where given bond prices, you solve your firm problem. And because it's a bit nasty, it's discontinuous, you can use projection methods very easily. We use this using value function iteration. We speed it up with policy function iteration. So this is easy to do. Now we have an outer loop that will update the bond price. Right? Now that I have my new firm policy, let me update the bond price. Now I have my new bond price, let me update firm policy. Right? The problem with this is, well, number one, it's very time consuming because we have lots of states. Right? It's a big problem. And then it has been shown in the literature that it's very hard to achieve full convergence, and I actually experienced it. We've been working on this for a long time. The reason for this is we have a non-convex constraint set. So if you plot the constraint set, you'll see that it's non-convex. So the numerical solution will oscillate between different areas of the state space. This has been very well written.
Why would you even do the inner loop, outer loop? Actually, it's more like best reply. It's not inner loop, outer loop. It's that first the firm solves a problem given a Q, and then secondly, then there's a Q computation given the firm's policy.
That's right.
It's sort of, it's not inner loop, outer loop, but it's back and forth.
That's right.
Like best reply in a game.
That's right.
Yeah.
That's right. So that's right. So that's what I'm doing. But when you do this, you see oscillations.
Yeah, but then why would you even think of looping? Why not just solve it? Anyway, maybe.
Yeah, or maybe this is something we can talk about. Yeah, absolutely. The default is when equity value goes negative. No, there is no strategic default because there's no walkaway value. There's default, the equity holders get nothing. So they're not going to default leaving money on the table in a way. So Chatterjee and Goncourt have an AER that actually showed that in the context of sovereign debt with just debt. And they show that they provide an algorithm that actually works pretty well. And the idea is when you have a non-convex constraint set, you linearize it, essentially. So what you have to do...
And make it convex.
That's right.
Linearize or do you add?
Well, linearize, I'm sorry, lottery. Yeah.
Okay.
Randomizing it, correct.
Yes,
sorry. With this morning, I'm linearizing it.
Convexifying.
That's correct. So what we do is we extend their algorithm to have endogenous investment. The problem with that algorithm is extremely slow and makes computation even slower.
It performs well, but it's extremely slow. What does performs well?
Yeah.
It converges. Performs well.
For a submission to AER?
Perform well in compared to it doesn't converge.
When you say large number of states, how many?
We have capital, debt, and then we have 3 shocks in there. 3 exogenous shocks. It's not huge, but
So when you say states, you mean 3 dimensions.
yes.
You didn't discretize or?
Everything is going to be discretized on a grid, yeah. It's value function iteration.
That's how many of those points were there?
I'll show you that in a second. So let me show you how we transform the model first to make it fit in order to converge. So what we do is we have to add a small continuous IID shocks to profit. So we add this little M shock that's going to be a truncated normal with a very small variance. And as was discussed before, you start with a bigger variance, so you convexify more, and then you shrink it until it doesn't matter. The smaller that volatility is, the longer it takes to achieve convergence. The larger it is, the faster it is, right? But the more you might change your problem. So you go until it's small enough, okay? And then the second thing is we need a strictly concave objective function. So what we're gonna do is we're gonna add a small dividend smoothing motive, which is gonna be a quadratic form. So kappa can be as small as you want. You can make it as infinitely small, as long as the computer says strictly concave and the
Smoothing would say something about adjustment costs from today versus yesterday.
So it's smoothing so this is the transform problem.
Yeah.
It's smoothing the objective function. So instead of a linear D, it's going to be a strictly concave D.
Yeah, you get away from bang solutions.
Correct. So we had this little shock here that's economically insignificant because it's very small, and it's IID, right? You had an IID shock, you're not distorting optimal policies. And then you concavify the demand, and that problem we can actually solve. Okay? It requires us to
Why is there the shock? It's just so you make a lottery based on it?
correct.
So then why have it be part of the profit flow?
So that's one way we can do it.
No,
But
you do sunspots.
maybe there's other ways to do
You
it.
just say M is just some random thing. It's observed, but you're saying it's extremely tiny, doesn't really affect any of the economics.
Right.
So make it a zero, make it a sunspot.
Okay.
And then it just becomes something on which you can base the lottery. And so then you get your convexification, but then it doesn't show up it literally has zero economic impact.
Okay. Maybe that's another way to do it.
You're just doing some randomization. I mean, game
So-
theory,
so-
you do public randomization.
so- So here it becomes randomization, and those become mixed strategies. And what we have to do is we have to compute default thresholds exactly, because that's a continuous variable. Once we do that,
But you just say, okay, there's this random thing that happens outside, and we check to see
okay.
what we do depends on that.
Okay, let me talk to you more over lunch. That's why, so I can see if it's the same thing or slightly different. So once we do this, the value function is well behaved, will converge, and then we use very slow relaxation for bond prices, and it takes a long time, but it eventually solves. Okay. So the state space, we use 100 points on K and B, and we use coarser aggregate risk and 16 idiosyncratic shock and a two-state Markov chain. So we have 1.2 million grid points.
So doesn't D now become a state for this extra randomization that you put?
This M,
Yeah,
it's
Yeah,
it's IID, so we don't need to keep track of it.
there's a realization today, but
So those become mixed policies. They become mixed policies with exact thresholds for the different policies. Yeah. But we don't need to keep track of it. So this problem is very long, and we solve this using CUDA GPU computing. The typical run is 5 hours, and we get a speed of 500 on the
Relative
next
to
guy,
what?
relative to an optimized straight single core.
that's pretty impressive.
Yeah.
But
If you Google my name,
because
you'll
the
see
software is
you'll
because
see
of
my
hardware.
computer.
Yeah, well, is it because of software or because of hardware?
This is hardware. That's why I can
So
do
in
brute force.
their card, they say the total number of floating point operations here is 500 times.
No, this is what I've been able to achieve by coding it, because you can code it in a way that takes actually longer if you don't code it right. You have to understand the hardware.
The GPU or the CPU?
You run the same algorithm on the CPU, you run on a GPU.
So are you using C++ or MATLAB?
I'm using CUDA, C++ CUDA. Yeah.
With C++.
I don't think you ever want to run the same algorithm on both.
And you're
What,
running
you want a
it-
benchmark?
No, well, no. The thing is that
But if he's using a single core CPU,
I'm using a single core, and then the CUDA is 500
that's
times
exactly
faster.
what you would see.
That's just for fun here. This adds no value except my bragging rights.
yeah,
That's all.
I know that there's a tendency in the GPU literature to exaggerate what the improvements really are, and the differences turn out to be more somewhat software and somewhat hardware. And
You can make me talk about it.
yeah, no, we'll
But
talk more about it later.
But unless someone codes this.
Yeah.
So what do we do next? We simulate a panel of lots of firms over 200 periods. We drop the first periods for steady state to get rid of initial condition, and then we compute statistics and run regression with similar data compared to the data. That's the idea. Okay. So, all right. So this is an AR1. The stochastic discount factor is parameterized as is done in literature. The idiosyncratic shock is also an AR1, and the idiosyncratic volatility process has two states, a low and a high volatility, which then kicks in when we discretize this guy. Profit function is very standard, decreasing returns to scale. Adjustment cost is 5%. Those are my parameters. So Tobin skew is market value plus debt over book value of assets, investment rate, profitability, leverage. The credit spread is that cost of debt minus the risk-free rate and default. Okay. So let me show you a few minutes. So let me show you the interesting results. If you compare moments of the data with moments of the model, we see that we're roughly doing well on the real side. Of course, it's loose. I haven't computed all the statistics yet. Leverage is very close to the data. Credit spreads of 1% of the data with 40 basis 0.4% default. We're pretty close with 126% credit spreads and 1% default. So we overshoots a bit here and a bit here. Okay. So you're gonna tell me, well, what's creating what? If you compare I'm gonna take the calibration that we use for that, the 5-period debt maturity with stochastic volatility, and I'm gonna bring it back to the literature with 1-period debt and deterministic cash flow. And by doing this, what you see is the real side doesn't change that much, but the financing processes are very different. First, you see that leverage is much higher, and we generate no credit spread and no default whatsoever. And that's been a curse of those 1-period models, is that you don't generate any default events and you don't generate any credit risk because there is no default.
Is that a probability of 0.007%, or is it 0.7% probability?
That's percentage points, so that's nothing. That's 1%.
Okay,
that's 1%. That one from default in my whole panel. Yeah.
Should round it to just 0.
Yeah, it's 0. Yeah.
So I think the problem in the sovereign debt literature is that people don't find enough leverage. In some sense, if you're going to long-term debts, you'll have even less debt than you observe. So
that's right.
So one of the big issues of the sovereign debt literature.
The big issue was the fact they couldn't generate any default and any credit spread. That was one of that was a joint puzzle. Because if this is high, then this is going to be very low. As this starts popping up, this is going to decrease. So yes. So all I want to claim is that we were able to achieve a reasonable match for leverage, credit spread, and default events. Right? Let me show you also. I've told you about correlation. If we write a model with 1-period debt deterministic, everything is driven by productivity, right? Because there's no default, so volatility doesn't matter. So all we see is that there's a strong correlation between investment and Q, and then there's almost a 0 correlation with credit spread because we don't generate credit spread in the first place. So you can generate that. If you look at our model, it improves the fit in terms of that quite a bit. So if I want to show you the effect of going from 1-period deterministic to 1-period stochastic, what we see is that adding risk in the cash flows obviously reduces leverage and increases credit spread and default events. So 1% and 0.8. So it does quite a good job already. But then if you bring it now to 5 periods, the amount of debt levers that up even more. Right? So these agency costs kick in even more. It reduces leverage further, increases credit spread, and increases default slightly. Okay? So I don't have this. So the deterministic stochastic I've shown you with 1-period debt. Well, there's 2 ways to get to the full. I've showed you one way. Should have put the other one as well. So both of these modeling long-term debt and modeling stochastic volatility both help you get a lot more risk, a lot more default event, and reducing debt. Okay. Let me show you an important.
What's the average duration of corporate debt?
So this is 5-period debt, so that's delta B equals 0.2.
In real world.
There's been a trend there. It was on way back with, it was 20, 30 years. It has gone down to maybe 6 to 10 years now. There's some cross-section and some time effects. So it has moved quite a bit. But
So the 5 years example is.
the 5 year is not, it's not crazy.
Yeah.
It's fairly reasonable for recent time periods. So let me show you maybe one or two more things. If you look at the impulse response, so feeding, it's not an impulse response, it's a counterfactual experiment. So we feed a big increase in productivity and trace it out. We see, so in a 1-period debt world, we see no credit spread whatsoever. When productivity goes up big time, we see a big investment spike, and you see it's financed throughout issuing debt, and then it goes back to the steady state, and it increases your Tobin's Q. So that's the positive correlation between Q and investment, and nothing happening on the credit spread front. When you look at the 5-period debt, now you see we have some credit spread in equilibrium, and an increase in productivity makes you a lot safer, so it decreases your credit spread. Investment spikes the same way, it's financed with leverage, and Tobin's Q goes up. So those are those qualitative discussion I was showing you before. So those correlations work the right way. Let me show you the same experiment with an increase from the low state to the high state in volatility. The 1-period debt shows no credit spread. This is the real options effect. When you have irreversibility, you tend to actually not invest at all. So here you just let the capital depreciate, and your leverage has to go down because now you're a lot more risky. Okay, and now you have become more risky. Your option to default has gone up a bit. So those are those correlations. So this is the 1-period model. If I show you the 5-period model, you can see that this is even stronger. Now the credit spread jumps up, right? You're a lot more risky now, and your leverage goes down because you have to delever. Okay. So those correlations go with what we say. And then the last thing I'll show you is those are regressions of investment rates on credit spread and Tobin's Q. And this is data from Gilchrist and Zakrajcek. And what you see is that if you run credit spread, it's negatively correlated. If you run Tobin's Q, it's positively correlated, but very small with a small R square. So those are the empirical puzzle. And if you run them together, you see that Tobin's Q almost disappears. Okay, and it's all picked up by credit spread. So it looks like credit spread is really the driver of investment. So what do? I'm going to run the model with deterministic volatility 1 period, so that's the benchmark in the literature, add stochastic volatility, and add the 5-period debt. What you can see is that it's negative everywhere with credit spread, so that's fine. Here we get 0 R square, so no hope of explaining this. Of course, with Tobin's Q, it's very strong. As you add stochastic volatility, that correlation reduces from 0.36 to 0.16. This is positive, which is nonsensical. It's still positive. Now this reduces to close to 0, and when you put stochastic volatility, it goes to 0. So it doesn't go negative quite, but compared to the 1-period model, it reduces to being almost gone. So the correlation with Q is still too strong in our model, but it's getting closer to the data. Okay, so. Here, yeah, but see here it's a bit, there's no R square because there's no credit spread here, so the regression is here. It had marginally, not much, I think. Yeah. So if you're wondering where this comes from, I've told you this correlation is going to be strong to investment rate and credit spread when you're close to default, right? And then what we did is we separated a sample of this last specification between far from default and close to default. So when the credit spread are high and when they're low. And we find that we do obtain that negative correlation as in the data for the firms that are close to default. So our margin is very strong when firms get close to financial distress in a way. Okay. So let me conclude. So we propose a new classical investment model with stochastic volatility and long-term defaultable debt. We find it reduces leverage, it increases probability of default and the credit spread. It increases the correlation of the investment and credit spread, although not all the way as to match the data, and reduces the investment correlation with Tobin's Q. So those are steps in the right direction. Okay. So we can use the model to measure the agency cost, and maybe we're going to investigate the effect of adding disaster shocks in there, see if it can move the correlation even more. So be very happy to hear your thoughts. Thank you.